Maximum 1 hour. Maximum 1 hour session. Yeah. Thank you so much. Maximum 1 hour session. I'm telling you, the most exciting session of AFR that you have never had. Yeah. The only thing that I would encourage of all of us is that we should be involved. These are all that I would want us to play together. So we are told here, Rock Limited, Rock Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on first when? On first, just give me a minute. 1 minute. Thought my physical students. All right, so let's continue. April 2025, question number 12. So I start again. Rock Limited, yes, AFRs, Advanced Financial Reporting. Yeah. So Rock Limited, a public limited entity, acquired 80% equity shareholding in the Paper Limited, another public limited entity, on the 1st of April 2024. Acquisition dates. So this is very, very important that we have acquired what here. You know, 80% is very big, eh? 80% means what here automatically this is a subsidiary, yeah? This is a subsidiary. Anything more than 50%, not unless you're told otherwise. You know, at times they will tell you, you have acquired 80%, but you have relinquished management of this entity to another party. Yeah, you've ceded control. But you see, there is no more information given. We acquired 80% of a company, meaning automatically that this company that have acquired 80% of the same, we are the controllers. We are the controllers. The acquisition consideration comprised an immediate cash payment of 2,400 million made on 1st April 2024, and a further cash payment of 1,331 million deferred until 1st April 2026. So this 1,331 million was not paid immediately on the date we acquired control of this company. So this is an amount that will be paid later if you're keen enough from 1st April 2024 to 1st April 2026. Those are how many years? 2 years. So this 1,331 has to be discounted. I'll be paying it in the future, but I need to discount this immediately. All right. So if I'm the one doing this question, ladies and gentlemen, this is what I will do immediately on this deferred payment. So we have a deferred payment of 1,331. So this one must be discounted. Discount it. Discount it. Because you must bring it to today's terms to be able to add to this 2,400 to get, in this case here, the acquisition price. So discount it. How do we discount this? So present value will be that 1,331 times PV fair, because it will be paid only 1 of 2 years from today, times PV. Have they given me the cost of capital? They will be able to give me the cost of capital somewhere here. You can see straight away that the cost of capital is 10%. So times PV, 10%. And this is coming 2 years. All right. So I'm very bright, just like yourselves. You guys appreciate the formula of PV. You know how it looks like, eh? raised to minus 2 like that. So is there somebody who can give me this answer? 1331 times 1.1 raised to negative 2. What figure are we getting? Raised to negative 2. What figure for sure are we getting there? 1100. Thank you so much, Ms. Karabu. Everybody today shall be a player. If you're not a player, you will allow me for the very first time for me to eject you from the field, because I want my first 11 today. Today, everybody in the group, of course, there are many, but I want to choose my first 11, the ones who are going to touch the ball. Everybody must be a player. Everybody must be a player. Everybody must punch the ball. If you're not understanding, you shall ask questions. If you're not understanding, you shall ask questions. All right? So, ladies and gentlemen, I'm told straight away that this is 1100. 1100. 11. So if I open my book here, if I open my new book here, we are doing AFR-April 2025, question number 2. So the very first working I've seen there is for the deferred consideration. A deferred consideration of 1331 payable in 2 years. Payable in 2 years from today. So we must discount this. So discount. So to discount, what I need to do, I will come and get present value, which will be 1331 or over 1. You can also use this formula. I know some of you are used to this formula. So you don't introduce raised to negative 1, negative n. Yeah, the same. This one here is the same, 1331 all over 1 plus the cost of capital is 0.1 raised to 2. So this will be 1331 over 1.1 raised to 2, which will be 1100. The same. Someone else will tell you this is 1331 times PV, present value interest factor, 10%, 2 years. So this one will be P, present value, will be 1331 times 1 plus R raised to negative n. So it will be 1331 times 1 plus 0.1 raised to negative 2, which will give us 1100, like that. 1100. And therefore, ladies and gentlemen, the total acquisition consideration. So total acquisition consideration will be the immediate cash consideration They gave us a figure there. But 500 there. Yeah, they give us 2400 plus present value PV of deferred consideration. Present value of deferred consideration, which is 1100. So when I'm calculating goodwill, I will be using this 3500 as the total consideration. No, total consideration. Especially for goodwill computations, I'll be using these 3500. 500. Now, if I'm the one doing this because I'm so much used to group consolidation, there is something else I will think about immediately. I would want to know the financial reporting period. Financial reporting period. Look at the financial statements given. If you look at the financial statements given, my friends, you can see they are ending on 31st. Financial reporting here, the financial reports are done at 31st. March 2025. This is great. This is great. Why am I saying it's great? Remember, we got a loan. We got a loan. We got a loan. A loan of how much here? We got a loan of 1,100 to enable us buy a subsidiary on the 1st of April 2024. Is it 2024? The acquisition date. Acquisition date. Acquisition date was on 1st April 2024. And we can see the financial reporting period is when? 31st March 2025. How many months do we have in between? This is a whole year. This is very, very good. Very, very good. It makes my work very easy that this subsidiary was ours for a whole year. Yeah, from 1st of April 2024 to the financial reporting period, we have a whole 1 year. So, you know, why am I calling this amount a loan? I'm calling it a loan because I was advanced an asset here, but I was told you guys come and pay for it after what year? After 2 years. It's as good as a loan. It is as good as a loan that I've been given. It is as good as a loan that I've been given. And if it's a loan, you must, in this case here, then account for the finance cost. Yeah, so finance cost on the loan, finance cost on the loan, or at times, of course, we know that it's not true, it's not a truthful finance cost. We call it what here? Unwinding or discount. I want to use many terms that you guys could be using. Therefore, the finance cost, we're given a loan of 1,100. We use our cost of capital, which is what here? 10%. Cost of capital is 10%, which will give me what here, somebody? 100 what here? 110. Which will give me 110. Meaning, ladies and gentlemen, that there is something that I would want to just finish with. Something very, very important. This amount is being treated as a loan. Something very important that I would want to come and just finish with this is now the deferred consideration. Deferred consideration. Liability at the financial reporting period. At the financial reporting period, which is 31st March 2026. So remember, when we bought this subsidiary, it was 1,100. And now we'll have accrued an interest of how much here? 110. So in my statement of financial position, I will be reporting this as a liability of what year? 1210 at the end of the year. Yeah. So remember, if you had stayed with this for 9 months, then this finance cost would have been prorated at times 10 over 12. But we stayed with this for the whole year. We stayed with this for the whole year. So by the end of then the financial reporting period, I have a whole liability of 1210, which is outstanding. So I'm still reading the question. I'm just trying to understand the question. I haven't even understood it very well. So I can see they have given me the statements of P&L, yeah, for Rock Limited, Paper Limited. No, we have skipped something. Come to this paragraph here. On 1st October, Rock Limited, together with another entity, entered into a joint arrangement to jointly control CIFA Limited, a public limited entity. Effectively, Rock Limited purchased 50% of the equity shares of CIFA Limited for an immediate cash consideration of 1,500. I love this because this is IAS 28. That one I know. It is IAS 28. IAS 28, it's on Mr. 50% joint ventures. Joint ventures. The joint venture, remember, IAS 28, Mr. 50%, we normally use what we call the equity approach. Do not consolidate joint arrangements. Don't consolidate. So when I'll be doing my consolidations, I'll be consolidating Rock and who? Paper. Because Rock and the Paper have a very serious relationship, brother-sister relationship, father-son relationship, very special. The relationship here is so huge because Paper is a subsidiary, is part of you. is part of you. Scissors is like a cousin. It's like a cousin, distant relative. So you're basically going to account for our equity. Ladies and gentlemen, let's now start doing this question. Let's start doing this question. So in this case here, what do I need to do here? The very first thing you need to do is to give us what we call the group structure. Give us the group structure. So group structure, we have a company called Rock, which acquired, in this case here, paper. And then it also acquired what here? Scissors. Paper and the scissors. Paper, we acquired 80%, which is more than 50%, meaning that paper is our subsidiary. And we were able to check this, is our subsidiary for a whole year, or a full year. Very, very important. If it was for 9 months, I would have indicated. We're already seen the timings for a full year. And then Rock acquired exactly 50% of scissors. Yeah, of scissors. So this becomes what here? A JV. A joint venture is normally accounted for the way you account for an associate. Joint venture and associates are accounted for in the same way. And we normally use what we call the equity method. We normally use what we call the equity method. So these scissors, I need to know the timings as well. When was scissors acquired? I don't have to go back to my question all the time. Please look at the paper and tell me, when was scissors acquired? It was acquired on 1st October 2024. So we have here 1st October, 1st October. So we have here 1st October, 1st October 2024. And when is our financial reporting period? Our financial reporting period, you guys gave me 31st of March 2025. You gave me the financial statements. So could you kindly count for me this number of months? Please count this number of months. All the time, ladies will always get this wrong. Yeah, all the time, ladies will always get this wrong. And I'm going to prove you right. We'll see. I've never seen a gentleman getting this wrong. The counting of number of months. They always get it right. Joseph Sang, I told you. Joseph Sang is right. Sylvester is right. Sylvester is right. So we have October, November, December, January, February, and when here, March. There are 6 months. Thank you so much. Ladies, for the first time, I'm seeing so many of you getting this right. I'm seeing for the first time. I don't get to see this. Many times, ladies will tell you 5 months or even 7 months. I don't know how they count. I don't know. But today they are right. Today they are right. All of them, today they are right. Today they are right. So 6 months. So it's very important for you to know the number of months you stayed with these organizations in the financial year. So this is very, very important. Ladies and gentlemen, once I've been able to read this, the next thing will be for me to go to the required. Never, ever read the additional information. Never. Once you have understood the group structure, don't read additional information because you will fail. Go to the required. So required, what do they want me to do? Number one, they want me to give them consolidated statement of P&L. Number two, they want me to give them consolidated statement of financial position. Yeah. So then we start right away, my very good students. Don't read additional information. No, never do that. Never do that. So come here, right there in the capital letters. What is the name of the group? It's Rock. Rock is the parent, isn't it? You are known by the name of your father. So Rock Group. Consolidated. Rock Group. Consolidated. Karibu sana. Statement. Consolidated statement of profit, stroke loss, For the year ended, I'm so sure that one everybody's very good at writing. I've never seen anybody getting it wrong there. For the year end, I don't have to write that. All right. Now, remember, my very good students, remember, please remember, whenever it comes to group consolidation, you normally take, consolidation is to put together. You're putting together. You normally take parent plus subsidiary. Yeah. And then, of course, the subsidiary can be time prorated, like times 6/12, times 9/12, etc. Here we are so lucky because we had our subsidiary for a whole year, which is 12/12. I've never understood. When we mark this, I normally sympathize with students. At this level, how do you consolidate an associate? This is a serious level. After this, we expect you to get out there and become a very, very good accountant. How do you consolidate a joint venture not unless you have an issue? You can't tell me this will be so wrong. That will be parent plus subsidiary at plus associate at plus joint venture. This will be so wrong of you. Always group consolidation, you take parent plus what here, somebody? Subsidiary. So we start with the first item. Yeah, we shall go back to that one. All right. We shall go back to that one. So P and L, of course, we are starting with that sale. We are starting there with what here? Sorry, yeah, with our sales revenue. So are you able to see the sales revenue there? So you write here, revenue. Now remember, we are talking of the group, isn't it? So you take parent and subsidiary. Parent, what do we have there? So this is 8520 plus what here, somebody? 5180, isn't it? If I get you adding the figure of Caesar there, I would recommend that you go and study another course, maybe home science. Not a group consolidation. Not a group consolidation. And don't take a calculator yet. No. We shall do adjustments later, isn't it? This is just but a pro forma, isn't it? This is just but a pro forma, but I'm again going to give you another advice. Yeah? Calm down, we shall overcome. We shall overcome. I want to use a language which will make you guys always understand this pretty well. So revenue, you only take parent plus who? Subsidiary. But are we there, first of all, ladies and gentlemen? Parent plus subsidiary. So from ladies and gentlemen, we have here cost of who? We have cost of sales, isn't it? So cost of sales, what are you able to see under cost of sales? You simply take the figure of the parent plus the figure of what your subsidiary. And remember, it's a pro forma. Don't pick your calculator. Don't pick your calculator, not unless you want you want us to send you somewhere, isn't it? So cost of sales, are you able to see 5510 for the parent plus what here, somebody? Plus 3440, isn't it? Then, of course, you'll be able to get what we call gross profit. Leave a line there. From there, we have now the other costs. The next cost there will be known as what here, somebody? Distribution cost. Distribution cost. So distribution cost, what do we have there, somebody? The parent. Oh, yeah, I'm alone, but I will overcome. I'm alone. 830, isn't it? 830 plus what here, somebody? Plus 470. Like this one, I can even go ahead and add it. This one I can go ahead and even add because I know rarely does it have any adjustment. I'm teaching you something that will make you come September, all of you will be coming to look for me here. You shake my hands. A shortcut, because I'm quite aware that you guys, most of you haven't started reading. Yeah, so I want to make your life easier. But don't add for now. Don't add for now. Do we have any other expenditure there? We have administrative expenses, isn't it? So we have admin. So parent, how much? 860 plus what here? Plus 520. Plus 520. Yeah, thank you so much. Then, of course, we shall be able to have what we call operating profit, isn't it? Shall be able to have what we call operating profit. So remember that operating profit is profit before interest and what here, somebody? tax is profit before interest and tax. So of course, you shall be able to leave a gap there, right? You leave a gap there, leave a gap there. Now, after operating profit, now you look at non-operating profits. The first one will be the share of profit of joint venture. Share of profit from joint venture, or if it was an associate, you would have also put it there. Leave a gap, just leave it like that. All right. Then, of course, we have some finance costs. We have a finance cost. The interest, isn't it? Do you remember the finance cost on deferred consideration? Finance cost on deferred consideration for the year was 110, isn't it? Deferred consideration was 100 because we stayed with this for a whole year. We stayed with this for a whole year. You're just laying down a pro forma. I'm so sure there must be a ninja who is looking for a calculator. We are laying down a pro forma. So then we have in this case here, ladies and gentlemen, what we call profit now before tax. Profit before tax. Leave a blank space. Profit before tax, leave a blank space there. Profit before tax, leave a blank space there. Then give us income tax expense. Like now, these are free mark, really. Are you able to see in this case here the income tax for the parent? Income tax for the parent is how much? 450. How about income tax for the subsidiary? Why are we not adding income tax for the joint venture here? Because equity method IS 28 is against that. Yeah, we don't consolidate joint ventures and associates line on line, line by line. No, no. So always group consolidation is parent and who? Subsidiary. And then we shall be able to get what we call profit for the what? Profit for the year. You leave it like that. Wacha hivyo namna hiyo. Usikasome additional information. Na ikifika pale ambapo unasikia refaria amepuliza kipenga. Ukisikia refaria amesema baki dakika 10, hata usikasome additional information. You get your calculator and add these things. Yeah. If you add these things the way they are, without even doing any adjustment, you'll end up getting more than half of the marks. And I'll tell you how these guys mark. By the way, like AFR, even AFM, when you get yourself getting a fail, there are two things. You never knew how to manage your time very well, exam time. That's number one. And then perhaps when you were being taught, you understood absolutely nothing. Absolutely nothing. Because we are normally very, very fair. Because we are looking at the structure. The moment you are good with structures, which you are taught in financial accounting level 1, you'll be able to pass this paper even without really putting in a lot of efforts. And I'll be able to show you why and how. So don't read. Go to number 2. Number 2, don't read additional information. Number 2, now they want us to give them consolidated what? Consolidated statements of financial position. As at when? 31st April. What is the name of the parent company? Rock. So you call it Rock Group. And then, of course, you underline. You underline like that. Underline. The first match, sorry. I will try to forget this. Thank you so much for the first match. You underline like that. 2020, I'm now committing mistakes, right? Very bad. I don't want to do that. Yeah. Now, this one, of course, the structure that you start with assets always there. Start with assets, of which you start with non-current assets. 3 marks, I can tell you. Non-current assets. So non-current assets, are you able to see the property, plant, and equipment? Property, plant, and equipment. Oh, yeah. For the parent company is how much? 4260 plus the one of the subsidiary called the paper 3630. And then, of course, later on, I'll be doing the uplifting thing. Yeah? Yeah, but for now I'm leaving them like that. Lakini referee akipuliza kipenga, una add, isn't it? PPE. Do we have any other non-current asset? Yes, we have what we call goodwill. Goodwill. Hii weka hapo. Utafanya baadaye. Utafanya baadaye goodwill. All right. From there we have investment. Investment in associate. In this very case, it's joint what here? Because the treatment is the same. In this question, it's joint venture, but I'm just putting it in plural for you to always know how you bring in this associate as well as a non-current what here? Asset. So investment in associate or joint venture. So these are some of those workings that I will not even do them as that, even if I was to be a student today. When they tell me to do this investment and associate, I'll simply come and draw for them something like this. Let them go to hell. Let them go to hell. You know why I'm saying that? You know, this entire question, you are supposed to do this entire question in how many minutes? 37 minutes. Not unless you're a genius. How will you be able to balance everything here, correct? But you cannot balance everything here correctly. Not possible. So there are those very, very workings that you may not do. Not unless you go to a question where the examiner tells you, Roman 1, do investment in joint venture. Do a working in goodwill. Even this goodwill, you'll be surprised. If I'm the one doing this, I will never do it. Because that is not unless you're a genius. Yeah. And I'm giving you very real practical case scenario because my time, during my time when I was doing FA4, the last one, I was number 1 in Kenya. Number 19 in a paper called the SBR of ACCA. That time we used to call it P2. And I've never balanced any single question. The only thing that I'm very good at is examination technique. That one you cannot beat me. You don't have to master everything. Like right now, when you guys how you are studying, you look at somebody going through some crazy things. There are things you're supposed to study, which I'll be able to show you in a moment. But because you're in class here, don't draw those bad things here. Wait. Upper sister Fanya, don't draw these things here in my class. Draw them for the examiner. So investment in associate, that we shall do. And then, ladies and gentlemen, please remember, once I do that, then I'll be able to get what we call the total non-current assets. Total non-current assets, which now gives me a chance to go to the current what here? Current assets. So are you able to see the current assets in this question directly? Oye, wameanza kuchoka hata kabla hata tusonge hata oye. Current assets, are they able to see the current assets oye? Fortunately, they combined everything for me. I can see here it is 3720 and what here somebody? 2270, isn't it? So current assets, I have 3720 plus what here somebody? 22 what here? 70. Then that is it. So I'll be able to get what we call the total what here? Total assets. Total assets. Now, these total assets are not a thief. They're normally financed through debt, equity, etc., isn't it? So we look at what we call equity and liabilities. You underline? So you start with the equity. So equity, you follow the table the way it is given there. We start with the ordinary share capital. You write it in capital letters. Ordinary share capital. This is a good question. There was no issuance of new shares. We shall only pick the share capital of the parent only. Parent company, isn't it? So the parent company, what do we have here? Parent company, share capital of the parent only. You see, parent is rock, eh? Free market margin, which is what here? Somebody 5,000. The same case here with what here? The same case with share premium. I'll pick this 500 the way it is. Alafu unaweza kusema tukatne vibaya. Haya. So ordinary share capital, parent only, 5,000. We have share premium. Yeah, share premium. Again, parent only, pre-mark. How much do we have there for share premium? I can't see this very well. 500 there. Thank you so much. Another form of equity will be, retained earnings. This is an asset belonging to, it's an equity item belonging to the owners of the business. So retained earnings, again, that diagram of mine, I will not do it. I will not bother. Trust you me. All the students who have bothered to do this, they keep on repeating this paper. Now from there, we know we have got another form of what here? Another form of permanent source of capital called non-controlling what here? Non-controlling interests. This I will do if I get time. If I don't get time, I'll draw that diagram for them. Yeah. And then, of course, we have, in this case here, liabilities, of which we shall begin with non-current liabilities. Those liabilities which span more than a year. So non-current liabilities, well, you don't forget it. Remember somewhere we had done this deferred. You remember the deferred consideration liability. Ilikuwa inakuja 12 what? What tumefanya hii? Ilikuwa inakuja ngapi? 1210. Are they able to remember that figure? 1210, not 1331. That we discounted and 1210. All right. We don't have any other than current liability. From there, we have current what here? Current liability. So current liability, take the one of the parent, which is 3,000, plus the one of the subsidiary, which is 1,900. Don't add it. Leave it like that. So then lastly, we shall be able to get what we call total equity and liabilities. Yeah. And then, of course, this is a figure which shall be able to balance with what here? Our total assets. We shall be able to balance with our total assets. It is now, after you have done this great work, that you shall be able to go and read the notes. So let's read the notes here. Additional information. Additional information. So additional information, we are told that at the date of acquisition, the fair value of paper limited's net assets approximated their carrying amount, with the exception of some office equipment whose carrying amount was shillings 560 million below its fair value. So meaning that these will be a value uplift. Yeah, because you see its book value is below. And we know that in terms of fair valuation, you're always told that to take your figures here to match what here somebody fair value. So the fair value is more than the book value. So these are fair value uplift. A fair value uplift. At this date, the office equipment had a remaining economic useful life of how many years here? Somebody? 8 years. Depreciation on office equipment is an administrative cost. No fair value adjustment were necessary with respect to the acquisition of CIFA what year? Limited. So can somebody in this case here do this working and then advise me, what am I supposed to be doing here? Somebody go ahead and do this very great work. We shall only do one group consultation question of this nature. Then we look at one with a foreign subsidiary, and then I go to something different, right? Yeah. Depreciation, yes. Great. Very good. Kumbe you guys mnajua maneno sana. Hii maneno naona mnajua sana. Let me get my question right. All right. So basically, ladies and gentlemen, in this case here, what do we have here? We have two great things here. So we know the fair value uplift there is 560, isn't it? Do you know the number of years? Number of years remaining 8 years. So what is 560 divided by 8? 70. So two things here. You see, when I was doing my group consolidation, yeah, this concept of fair value uplift had not been known. Now that it has come to my attention in the additional information, I need to come straight away here to my group consolidations. I pass this adjustment in my balance sheet first. So in terms of PPE, what will I do? I will come and say plus what here, somebody? Minus the value lost on this, minus 70. You see now, this is a value uplift, meaning value increase. So you take 560, add it there. But you see the 560 also lost something, isn't it? Yeah. And then remember this 70 as well is going to be taken somewhere. The 70 is depreciation. Depreciation, ladies and gentlemen, will have to go to the income statement. So look for your income statement. Look for your income statement. Are they able to see the income statement? So this income statement, depreciation, if it is depreciation of plant, depreciation of plant, we normally take to cost of what here? Sales plant. Or factory, anything that is used for manufacturing. Yeah, manufacturing, ladies and gentlemen, we normally this depreciation of these will go to cost of what here? Sales. But what if, for example, you have depreciation of a distribution van? This one here will go under distribution expenses, because you see distribution van comes after you have manufactured, after production. So that cannot go to cost of sales. In most cases, your examiner will tell you where you're supposed to be charging that admin expense. In this case here, they tell us where we're supposed to be charging that admin expense. But it's about to charge wapi? Woi, I'm alone. In the administrative cost. Charge it in the administration cost. So in this case here, the main expense, come here and add what here? Somebody 70 there. So now you can see, ladies and gentlemen, as I progress, these are 3 marks that I'm getting. What I've seen from your questions, your examiner will tell you the item being depreciated here is a distribution van. That one would have come near depreciation. When they tell you that the item being depreciated is a head office is used for administration, you bring that one here. Or they give you a policy, they tell you this item should be able to be charged, depreciation should be able to be charged under admin, like now they have told us. When they're silent, you always charge that under cost of what here? Sales. So go to straight away addition information number 2. So addition information number 2, what are they telling us there? Rock Limited measures the NCI in subsidiaries at fair value. The fair value of the NCI in paper limited at the date of acquisition is this. I will be able to work out on this. This I will do. Because I know like now this one will help me in doing my NCI calculation, may help me in this case in doing my group. If I have time, I'll do that. For now, I'm looking for obvious things. I'm looking for fair value uplift. I'm looking for any parent subsidiary sales. I'm looking for what we call unrealized profit. I'm looking for the easy marks so that I earn them and I go to other serious things. So this one I'll mark it, part of X. We go to 3. During the year, ended 31st March 2025, Paper Limited sold goods to Rock Limited amounting to how much here, somebody? Who is Paper? Paper is their subsidiary. And the Paper sold goods to who? To the parent company called Rock. So from there now we need to ask ourselves a simple question, ladies and gentlemen. Remember, please listen and listen to me very well. Rock is the parent. We have Paper. Paper in this case here is the sub. Yeah. So parent, yeah, and subsidiary. Remember, sub part of subsidiary is part of the parent. If, for example, this is Aura, and then I have here my son here. Yeah, I'm doing some business games. Yeah, these games, right? I love those games. So when he comes to my shop, I tell him, I mean, pick whatever games you want plus the console machine. Take it. Those things may be worth like say 200,000. So when I'm doing my individual, but when I'm doing consolidated books, this sale will be what here somebody fake sales. Parent and subsidiary, whenever they do business, at the end of the day, at the end of the year when I'm doing my financial report, I need to know that that kind of a sale is fake and remove it. So I need to understand the concept of fake things. Fake things. And these fake things will always come in what we call intra-sales, and then we have what we call intra-what here, intra-owings. These are fake. Whenever you hear about anything fake, you always think about that fake. And if they are fake, they need to be eliminated. Intra-owing is also fake. Just like, for example, today in the morning, my wife comes and tells me, Mwalimu, she normally calls me Mwalimu, please give me 100,000, I will return. Do you think I will ever get this money back? Will I ever get this money back? So I'm better off in this case here knowing that this is a fake owing and I need to go to my owing and write it off because I will never ever get this amount. It's a fake owing. So now we have an internal sale of 500, an internal sale of 500. If you look at, ladies and gentlemen, this question here, they're telling us, this question here, what are they telling us in there? This question here, they have told us something very nice. They have told us, number 3, during the year ended 31st March 2025, paper limited, paper is the sub, sold goods to Rock. Rock is what here? Rock in this case here is the parent. So this is fake, sold, fake. Goods worth 500. And be able to make that adjustment very fast. This adjustment, first of all, we make it in the income statement. So in the income statement, you shall remove this fake sale from the revenue. There is a fake sale there. And from the cost of what here? From the cost of sales. Any intra-sales shall always be removed from group sales and from what your group cost of sales. AFR, yeah. Group cost of sales. AFR, yes. Group cost of sales. Why is that the case? Why should you remove this 500 from cost of sales as well? It's because cost of sales, we have opening plus what here somebody purchases, right? Minus clothing. So in cost of sales, we have purchases. So one company said, I sold goods to you worth 500. The other company is saying, I purchased goods from you worth what here? 500. All right. So always remember, ladies and gentlemen, that you shall always, most importantly, always remember that you shall always do what here? You shall always deduct the internal sales from the revenue and from the cost of sales. And once you have done that immediately, always remember what we call the UPS. And realized profits on stock and realized profits. And realized profit on stock. How do we get this? Profit margin times the remaining intra-sales. Remaining intra-sales. So you take the profit margin times the remaining intra-sales. That's how we get UPS. If you read this question very well, my friends, if you read this question very well, my friends, we are told during the year ended 31st March 2025, Paper Limited sold goods to Rock Limited for 500 million at a markup of 25%. This examiner is crazy. Instead of him giving me margin, he has given me markup. But I will not panic because I know if markup is A over B, then to get margin, you will take A over A plus what here somebody. B. So if markup is 25 over 100, then my margin will be 25 all over 25 plus what here, somebody? 100. Yeah, 25 over 125. Leave it like, you don't have to cancel it like 1 over 5. No. No. Always remember, we normally use, ladies and gentlemen, in group consolidation, we want the margin. And the margin has a bigger base. Please don't confuse this. Don't confuse this. Wakwambia markup is a quarter. And you want to get, in this case here, margin. Kumbuka kwamba margin ina makalio makubwa. Hii hapa. So nasema 1 over 4 plus what here, somebody? You increase the base of the margin. Margin has a bigger base. So inakuwa 1 over what here, somebody? 1 over 5, like that. So are we together up to here? Are we really together up to here? Are we together up to here? Are we together up to here? Great. So then I've been able to get the profit margin is 25 over 125 times not the 500, not the 500, not the entire internal sale. No, remaining internal sales. And the remaining internal sales, they are telling us, ladies and gentlemen, yeah, half of these goods were still held by Rockley, half of them were still remaining. So in this case here, times what here, somebody? Times 250. Times 250. So is there somebody who can give me this? Mm-hmm. 25 over 125 times 250, 50. So this is what we call the famous UPS, unrealized profits on stocks. And anytime they give us unrealized profits on stock, two things: add it to cost of sales, subtract it from group inventory. So anytime you see UPS, these are chorus that should always ring in our mind. Anytime you get UPS, add it to cost of sales, and then you subtract it from group inventory. So look for your cost of sales. Your cost of sales in the income statement. Your cost of sales, we have this one. So you come and they say plus what here? Plus, was it 50? And then statement of financial position, you go to inventory. If inventory is not there, yes. Current assets, yes. Current assets here. So current assets, you say minus what here, somebody? Minus 50, because you see current assets inventory has been overstated. Inventory is overstated. IAS 2, International Accounting Standard number 2, tells us that we shall never put profit in our stocks. Always take it away. Yeah, according to prudence concept. Because how long will it take you to sell these items? Why are you putting your profits? Or some gani? Sijapata hiyo joke yao. We ignore it, Okay, minus 50. Okay, great. They have told me to ignore it. Okay, great. Thank you so much. Now, ladies and gentlemen, we are doing very, very well. The next thing that I would want now to come and pick up here, do we have any goodwill impairment review performed on these? Revealed that both goodwill on acquisition of Paper Limited and the interest in Caesars Limited were what here unimpaired. Very good. No adjustments to my income statement regarding these losses here. Very, very good. So then now if I'm the one doing that, I will stop there and get my calculator out and punch these figures now pretty fast. I'm telling you, I will get 20 over 20. If I go this approach, I will get 20 over 20 without knowing even what I'm doing. So we start with this. Is there somebody who is able to give me the group revenue? Please add together here. Group revenue, 13,200, So I'm told this is 13,200. How about group cost of sales? Group cost of sales, 8,500. You subtract Give me the gross profit. Gross profit. Thank you so much. 4,700. Are you able to give me the distribution cost? Distribution cost. 1,300. Who in my fiscal students today they're not helping me. 1,300. How about admin expenses? 1,450, yeah? 1,450. 1,450. Thank you so much. I'm not even. So kuja hapa straight away. Please give me the operating what year expenses. Operating expenses. No. Operating profit, I mean. Subtract everything, give me the operating profit. 1950, the year that I was born. Yeah. I'm lying, yeah? Share of profit from joint venture. This one, wachana nayo for now. We shall overcome you, wachana nayo for now. Finance cost, correct. Profit before tax, wachana nayo. Are you able to give me the income tax expense? Income tax expense, oh yeah. 680. 680, like that. Your profit for the year, wachana nayo. Wachana nayo. Kila kitu wachana nayo namna hiyo. Enda kwa assets. Assets PPE. Is there somebody who is able to give me the PPE? PPE, please, Adapter. Give me the PPE. 83, 80, 83, 80. PPE, 83, 80. 83, 80. Hapa Google nitamchekelea examiner, naweza mchekelea sana. Hata ngoja nifanye, tutamfanyia. Hata hii nitamchekelea. Sasa stalia. Wewe unajua nimepita tayari. Haya. Current assets, are you able to give me the current assets? Do we have ngoja kidogo. Why current assets? Do we have any inter-owing? I think kuna mahali hatujashika vizuri. Inter-owing. Do we have any inter-owing? Yes. 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 So look at note number 3, yeah? Look at note number 3. During the year ended 31st March 2025, Paper Limited sold goods to Rock Limited for 500 million at a markup on cost of what, yeah, somebody? 25%. Half of these goods were still held by who? Rock Limited at 31st March 2025. And the balance payable on this account was what, here, somebody? Still outstanding. What was the total balance there? Total balance is the total intra-sales, isn't it? The 500. So that balance, total balance, ladies and gentlemen, please, sorry for that. The total balance, I not read the whole of it. The total balance was still outstanding. That is a fake liability. So minus what here, somebody? Minus 500. And we must adjust also what here, the current liabilities. So current liabilities, are you able to see them? You see, half what was not sold, but the total balance was still outstanding. The half is about sales, but the amount which are the invoice, these guys had not been paid in total. So one company is saying, hey, I have a fake receivable of 500. Go and cancel it. The other guy is saying, I have a fake payable of 500. This is my father. I will not pay. So go and cancel it. You cancel it in the payables and you cancel it from the receivables. So you cancel it from the current assets and from the current what liabilities. So please give me these figures now. So hii inakuja ngapi oye in form of current assets, ladies and gentlemen? 5440. Wachana na hiyo mambo mengi, equity umepata, hii umepata hiyo. Haya. Deferred consideration umepata. So nipatie figure ya mwisho, which is current liability. Figure ya mwisho kabisa, which is current what year liability, 4,400. Sasa hiyo swali, can I tell you something? By the time you are hitting when mwalimu wa hii, it will be about 40 minutes. 40 minutes is beyond your 37 minutes. Usifanye kingine chochote, na ukifanya paka mali nimefika hapo, utapata if not 20/20, you'll get 16 over 20. Why? Because remember how we mark this thing. Utakuja hapa, angalia all the solutions. La Castle. All the solutions. Utaona amefanya 1, 2, 3, 4, 5. Hata hizi total wakupatia bado marks. Watamark everything ambayo umeandika. Alafu wana wamesema any 5 at, for example, 2. Any 5. And you'll have gotten so many ticks, correct? Correct here. Yeah, any 5 at 2 like that. I guess unapata mwanafunzi mwenye ajui this approach and sweat bado kwa workings, and those workings are never marked at all. They don't carry any marks. No marks at all. Yeah, but not because we are here to study, ladies and gentlemen, allow mwalimu to do some of these little workings here and there, isn't it? Yeah, but do you agree that this approach is quite nice and it can save you? Do they agree that this approach is quite nice and it can save them? Great, yeah, great. So then let's look for these other workings. Tafanya chache tu. Tafanya chache. Genius, no, I'm not a genius. It's only that I was in charge of group consolidation at Arrow. For 5 years, I was doing group consolidations for East African breweries, Equity Bank. So I have these big things. Yeah, unaenda shortcut. You'll never go wrong. Unapata mwingine ameanza ati workings 1 mpaka workings 12. Utaanguka. Performance. Yes. Copy and paste, yes. Copy and paste. And then look for the necessary skill work. Because you see, you're fighting with this time as well. Yeah. Wanafunzi wengi bado wanawaita nje nikifanya invigilation those days. I used to very vigilate time. Unaona mwanafunzi ameshinda kwa wale group 1.5 hapo na mtu anamwambia mazee hakuna maswali mengine. Anacheka na wewe iko maswali mengine. Go to other questions. Iko theories. So let's do some few workings here. Like how many of them? Not very, very many. Very, very few. Like one of the workings that I would want you to know. Yeah, one of the workings I would want you to know is a working for retained earnings at acquisition. I need this when I'm computing goodwill. And remember, this is for the subsidiary, isn't it? For the subsidiary. Yeah. Do you remember the number of months we stayed with the paper? It was a whole year. We stayed with the paper for a whole year. Iki to paper. No, paper tiger. We stayed with the paper for a full year. Right? So it's important for you to know that. Important for you to know that. So then, in this case here, give me the retained earnings at the end. Retained earnings of paper. Remember, this is paper, right? Paper. Retained earnings at the end, ningapi at end. Angalia statement of financial position, oh yeah. The closing retained earnings. 1800. The statement, hata niwekee hii hapa. Sasa shida vile nishawaambia ile waanze kuchora ile emoji ya kucheka. Sasa nataka concentrate. Sasa wataka concentrate wanafunzi sasa. You can see retained earnings. You see paper is the one at the middle there. The subsidiary is the one at the middle. So retained earnings is this one, 1800. So retained earnings at the end is 1800. How about profit for the whole year? Profits whole year. Unasema ni ngapi? 520? Aye. So then I want retained earnings here at acquisition. You see, this is X because this is what is not known, isn't it? So X plus profit for the whole year of 520 should be equal to what here, somebody? 1800. Yeah. So meaning that X will be equal to 1250, yeah? So X will be 1800 minus 520 which is 1280. So working on this retained earnings at acquisition inashinda wanafunzi wengi sana wengi. Ungeamua umekaa na 9 months lazima ungeapportion 520 Kwa hiyo umekaa na hiyo subsidiary for a whole 9 months. Ungeapportion hiyo mimi nimwache. Hii tulikaa nayo a whole year. So no apportionment of this 520 at all. Now after assuming umekaa na hii subsidiary here from here 9 months. So ungesema times what here 9 over, because you see 520 is a whole year. 920 is a whole year. Be very careful with that. I'm so sure you must be having an example of that nature. Yeah. To the next one, number 2. Working number 2 now. Working number 2. We have what we call net assets. Net assets. What we call the capital employed. The capital employed. What we call the capital employed. Alichelewa sana. Kwa nini? Alichelewa sana. No. We were supposed to have the AFR from 9:30. I know you're doing AFR. Oh. So remember the capital we are employing, ladies and gentlemen, goes towards what here? Equity. It goes towards acquiring equity. Because you're buying ordinary shares, isn't it? You're buying any share premium. So whenever we talk of capital employed, it will be very important for you to pick the equity elements of what is somebody's subsidiary who is who? PayPal. And remember, this is working number 2, the net assets at acquisition. Sorry, net assets at acquisition. I want this at the date of acquisition. So net assets at acquisition, tuanze na gani? Tuanze na ordinary share capital. So tuanze na ordinary share capital. So ordinary share capital never dances. That one normally remains the same throughout. So ordinary share capital of the subsidiary at the end of the year will be the ordinary share capital at acquisition. Is there somebody who is able to see the ordinary share capital of the subsidiary? Oh yeah. If you look at these ones and gentlemen, you can see ordinary share capital for paper is what? 2,000. 2,000. You want to copy too? It's about 2,000. Something else there is the share premium. You pick it the way it is at the end there because it doesn't dance. It always remains the same. So share premium, how much? 200. When you are doing your capital employment, the capital to fight for you, you'll be able to acquire retained earnings. So remember, these will not be retained earnings at the end. So retained earnings at acquisition. That's why I started with this working. Retained earnings at year figure 1280, isn't it? 1280. Ya mwisho kabisa kama unakumbuka vizuri ni uplift. Value uplift of assets. What we call evaluation surplus. This evaluation surplus will be part of your benefit. So value uplift at acquisition. Do you remember how much that revaluation was worth? You're going to kuja ngapi? 560. That is it. Kuja ufanye word zote. Atasema tu ni genius, na sio genius. Ulijua siri. So inakuja 40-40, 40-40. Thank you so much. So always remember that net assets is the same as what the capital that is employed to buy the equity holders of the subsidiary. From there, now the last working that I will do will be the working of what here? Goodwill on acquisition. Goodwill on acquisition. So goodwill on acquisition. Yeah. Kidogo hapa kwa retained earnings. Retained earnings are done that. I'm fighting, you know, I have only 10 minutes. I'm sorry, I'll not be able to repeat. I'm really, really sorry. I done retained earnings at the beginning, yeah? If you remember, I done this retained earnings somewhere. I won't repeat because I only have 10 minutes to AFM. At times it's important to freshen up. After all, you guys have the video. After all, you guys have the video. Yeah. So for goodwill, what are we looking at? How much we paid ourselves to acquire this RCM business vis-a-vis the value, the worth of this business, isn't it? So we have here consideration transferred, consideration paid by parent. Ilikuwa ngapi sasa? Tulikuwa tushafanya already kwa working fulani. Was it 3,500? We never bought 100%. We only bought 80%. There's another party who assisted us. So we have here consideration paid by NCI. Consideration paid by non-controlling interests. So you look at the value of non-controlling interests on acquisition. So this is the same as NCI on acquisition. NCI on acquisition. I wish I would get another machine which can project this question for me. Nisikuwe na make movements ila niwestia time sana. Lakini siwezi nikaona hiyo. Hata kama nilisaidia hizo papers nataka vijana. But thank you very much. So are you able to see note number 2? Rock Limited measures the NCI in subsidiaries at fair value. The fair value of an NCI at the date of acquisition was 800 what year? 860. So 860. All right. So this is the total consideration. Total consideration. Total consideration, please add for me. Total consideration. 4360, yeah? 4360. Then you strip the net assets you acquired, eh? Less net assets. Net assets of serve at acquisition. You tumefanya hapo juu, isn't it? You tumefanya hapo juu. Net asset of the serve at acquisition. 320, yeah? 320. No. Net assets. 40, yes. Thank you so much. 40. So you come and subtract. Then you will get goodwill on acquisition. 320. Fortunately, there was no impairment, eh? No impairment. So this is goodwill reported. Goodwill reported. Kama kuna time, oh yeah, uja hapa weka 320 hapo una smile. If you have the time. If you have the time, goodwill hapa 320. Weka hapa 320. Because I'll not do those workings in an exam. Not unless the examiner wants you to. Not unless the examiner asks you, like in Roman 1, calculate the goodwill. Otherwise, when he tells you do consolidated statement of financial position, blah 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 blah, then you will not be able to get time. Not because you don't have the you have the capacity, but you don't have the time. Yeah, but what I know with my experience, you will not have that time. I would want you to use that time to answer other questions like IFRS 2. Yeah. IAS 12, deferred taxes. I would want you to create time to answer those questions. All right. Ladies and gentlemen, because we have another class starting up, is it possible we continue with this question tomorrow at 1? I'm only left with very, very few workings, the joint venture. But again, I don't even have to do it. So it's my hope that you guys have gotten something as we disappear. As we disappear. Remember, for AFM, we are going to use the same link. We are going to use the same link. We're going to use the same link. Yeah, I want you to be very, very confident. And that is why we even want you to pay your fees mapema sana, eh? I hope you have seen the offers we have, eh? Those guys who would want to pay fees for the next semester. So I want you to be very, very confident and start paying your fees mapema. Huh? Atapata? Haujaona bado? Kuna a lot, because when you pay your fees, mapema, you get this free short course, either QuickBooks, artificial intelligence for free. And then, of course, you get 10% discount. Yes, yes. AI for accountants, and yeah, there's another thing. AI for accountants and auditors, a very, very good course. Very, very good course. Yes, yes. Yes, yes, yes. Otherwise, thank you very much. See you. We're using the same link for FM. We're using the same link for FM. Thank you. Thank you. Be blessed big time. Be blessed big time. Be blessed big time. Or we do something different, eh? The same. Your link here. Scroll up for screenshots. I'm so sorry I won't be able to do that because I only have 5 minutes. Yeah, to start the meeting. Scroll up quickly. Somebody can give you that working, yeah? Somebody can give you a working for today. Somebody can screenshot their notes and then they send. Bye-bye. Or we do cash flows. Thank you so much, Imani. Thank you, Shalom.